Nokia stock is currently experiencing sharp active trading in the market, with the live intraday stock price sitting at 15.40 USD on the New York Stock Exchange, marking a slight decline of 0.40 USD, or down 2.55% as the trading session moves forward on this Friday afternoon of May 29, 2026. While the daily board shows a minor cooling off, the bigger narrative surrounding this legacy tech name is completely detaching from what ordinary retail investors recognize. If you open up a standard individual brokerage account on a Robinhood stock trading setup or view it through your Fidelity trading platform, you might see this pullback and assume it is just another boring day for an old-school telecom company. But looking beneath the immediate ticker tape reveals a massive shift. The hidden reality that most casual traders are completely missing is that an institutional wave of capital is quietly reassessing Nokia stock as an unexpected backbone of data infrastructure. Just this month, executive buying hit the public registry, showing senior insiders buying hundreds of thousands of dollars worth of shares directly on the open market after the asset had already experienced a major multi-month surge. Typically, corporate insiders exercise options or liquidate when a stock hits a multi-year high, but the fact that leadership is aggressively adding exposure tells us that their internal projection models show an entirely different valuation than what the historical price-to-earnings ratio suggests. This creates an immediate curiosity loop for anyone tracking the broader market momentum. The common expectation among retail investors, particularly those managing their own portfolios on online investing sites or experimenting with self-investing, is that Nokia stock is a relic of the early cellular world, forever trapped in low-margin hardware cycles. People see the brand and immediately think of consumer hardware from 2 decades ago, or they view it as a slow-moving utility provider that simply sells antennas to telecom giants. The prevailing market sentiment suggests that it cannot compete against hyperscale software firms. But the reality challenging this view is that the enterprise has completely shifted away from its legacy consumer dependencies and transformed into a critical infrastructure provider, newly amplified by high-profile cloud partnerships and automated network software. Morgan Stanley recently bumped its target, and major brokerages are scrambling to update their coverage because the company is embedding automated machine learning models directly into broadband and carrier networks to fix outages before human technicians even realize there is an issue. When you look at current online investment trends across popular retail platforms like the Robinhood app or via professional setups like Interactive Brokers Trading, the sheer volume behind this legacy name has taken the market by surprise. Over the last 3 months, trading volumes have surged well above the historical averages, driven heavily by automated inflows and institutional repositioning. Institutional managers utilizing advanced portfolio tools or allocating capital through Fidelity mutual funds and Fidelity ETFs are building long-term blocks. They are recognizing that as cloud data networks expand, the underlying telecom infrastructure must become infinitely smarter to handle the load. This massive spike in institutional activity has driven the valuation to over 90 times trailing earnings, a metric that would look terrifying on a standard SoFi active investing filter if you didn't understand the structural transition happening under the hood. This exact tension between expectation and reality is what makes the current market behavior so fascinating. Investors who look at a standard stock chart might get spooked by the high multiples, but those digging into the institutional order flow on an Interactive Brokers platform see a business model being aggressively re-engineered. The massive capital expenditures pouring into global data infrastructure are flowing directly into the corporate order books. This has triggered a massive rally over the past year, lifting the price from deep single digits up toward the 15 to 16 USD range. While a 2.5% intraday drop today might seem like a reason to pause, the underlying momentum is supported by clear corporate wins, including a major regulatory victory and a deep alliance with major semiconductor chip designers that are co-investing to optimize carrier networks. Let's pause for a second to gauge what the community is doing with this asset. Comment below how many shares of Nokia stock you currently hold in your portfolio, and let me know if you are buying this recent dip or looking at alternative infrastructure plays instead. To understand how the corporate entity arrived at this inflection point, we have to look closely at what the business actually does today. Operating through clear institutional segments, the core driver is its mobile networks division, which provides the physical radio access networks and microwave links that power global cellular connectivity. Alongside this sits their network infrastructure and cloud services, which cater directly to web-scale enterprises and public sector clients looking to build completely private, highly secure wireless environments. This segment is where the real margin expansion is occurring. Instead of just selling heavy steel and copper hardware, they are licensing high-margin cloud-native software and network-as-a-service models. This shift from one-time hardware sales to recurring corporate software subscriptions completely alters the cash flow predictability, which is exactly why modern automated tools like the Schwab Intelligent Portfolios algorithm or a specialized SoFi robo-advisor are beginning to flag these underlying metrics as structurally improved compared to historical performance data. Historically, the company struggled under the weight of expensive acquisitions and intense price wars in the traditional carrier equipment space. Older financial reports from 2024 and 2025 show compressed gross margins and sluggish growth that forced management to completely abandon low-margin consumer segments. They chose to streamline operations, reduce headcount, and focus entirely on core research and development. That painful restructuring period is precisely why the asset sat flat for so long, alienating retail investors who wanted immediate returns on platforms like SoFi Invest or through a basic individual brokerage account. But that exact period of consolidation laid the groundwork for the modern margin profile. The company's massive intellectual property portfolio, managed under its specialized technology segment, continues to generate steady, pure profit licensing revenue from virtually every major mobile device producer worldwide, providing a deep financial safety net while the infrastructure business scales up. Looking toward the forward horizon, the outlook presents a mix of high-stakes catalysts and clear execution risks that investors must balance. The optimistic scenario rests on the continued global rollout of intelligent broadband networks and private corporate cellular clouds, where the company now commands premium pricing power due to its automated software layers. If the enterprise contract wins continue at the current pace, the forward revenue projections will easily justify the current premium valuation, potentially triggering another wave of short covering and momentum buying across major retail platforms like Robinhood Investments. Furthermore, upcoming earnings reports scheduled for midsummer will serve as a major test of whether the recent operational improvements are translating into hard free cash flow. However, the risk profile cannot be ignored by anyone engaged in self-investing. Trading at over 90 times trailing earnings means the market has priced in near-flawless execution. Any delay in corporate capital expenditure cycles or a macroeconomic slowdown that forces major telecom carriers to pause their infrastructure upgrades could result in a sharp valuation correction. If reality falls short of these newly inflated market expectations, institutional funds holding large positions through Fidelity Investments or Interactive Brokers account allocations will not hesitate to rotate their capital out into safer enterprise alternatives. The high valuation leaves very little margin for error in the upcoming quarters. In summary, the central conflict surrounding this legacy tech name is the classic gap between historical public perception and forward-looking institutional reality. While the casual trading community often views the company through the lens of old mobile phone history, the smart money is treating it as an essential, high-margin software and infrastructure play. The recent open market insider buying confirms that corporate leadership is highly confident in this operational shift, even as the stock trades near its multi-year highs. Today's intraday dip to 15.40 USD showcases the natural volatility of an asset undergoing a massive institutional re-rating, leaving individual investors with a critical choice on whether to trust the structural transformation or wait for a deeper margin of safety. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.